this defense, or rather this EV mobility arm will continue to give good returns. But let's get back to the markets now. Looks like it's going to be a solid opening, a decent opening rather. 50 points higher for the Nifty. The Sensex is up 150 odd points, led higher by a lot of stocks. Bajaj Auto on the back of that BOFA upgrade is looking pretty good, so 1% higher there. In fact, a lot of auto stocks. M&M is also in the green. Hero MotoCorp holding up with a gain of about 1% odd. Restaurants, brands, there was a deal that happened over there, so just keep an eye out on that. It's up about 11%. RBA, which is Restaurants Brand Asia, so that's another stock that you'd want to look at this morning. But here we go, last trading day of the week, and the first take on the opening bell coming right through. It's looking pretty good, 60 points higher now on the index. The Sensex is up about 220 points, and the Bank Nifty is up 156 points. So holding on to 20,000 with ease, in fact, almost inching towards 20,200 now, the Nifty at a fresh record high. The Sensex as well is inching towards that 68,000 mark. So don't, lose sight of what's happening with the grand old index. It's also, getting to psychological levels. What's leading from the front today is metals. Hindalco, Tata Steel, JSW Steel, all in the green, up about 1 to 1.5%. Bajaj Auto is your top Nifty gainer right now on the back of the BOFA Securities upgrade that you heard about just a while back. M&M is also in the green. Tata Motors, HCL Tech, LTI, Mindtree, Hero MotoCorp are a couple of other stocks that are trending in the green. So what's not looking good is FMCG. You have HUL, Asian Paints, ITC, just taken a back seat. Tata Consumer Products, little bit of a back seat this morning, nothing alarming. But apart from that, HDFC Life, Bharti Airtel, NTPC, Kotak Mahindra Bank are some stocks that are a tad bit in the red. The good part is, and what the market will really, appreciate, is the fact that mid-caps are surging. So, there were a couple of days when mid-caps were under a bit of pressure, but now that pressure has receded, and the mid-cap index is up 230 points and very, very strong advanced decline ratio as well. So, good, strong opening for the market.
Oh, absolutely. The Nifty is doing quite well with that 60-point gain. Mid-cap's doing even better. I straight away want to get to some of the newsmakers. Now, Siaram Silk, they have increased their buyback price quite substantially. The buyback price is now 720. Earlier, it was 650. The stock is loving it. It's at 631. You'll get 720 if you want to participate in the buyback. 7.5% up. Straight away, Patel Engineering announced some order wins. 5% on that stock. Sequent Scientific is looking to sell off their API facility, I think, facility in Thane. The market is taking that well for the time being. 5% up on that stock. There's GMM Fordler, which has done a small little acquisition, about 3% up there as well. Bharat Forge, Kalyani Forge, some green on these two as well. We were just telling you about the tie-ups that they're doing with a UAE-based company on armored vehicles, and both of those stocks are up and about. So the newsmakers are positive. Alchem, where there's talk of, this IT survey, income tax, that stock is down about 0.5%. MetPlus isn't reacting too much. MetPlus is very, very flat. Interglobe, to their entire engine issue, it's again down about 0.25%, not too much. Let's move beyond news and see what's happening. Restaurant Brands Asia, Nimesh has been alerting us about the prospects of a block deal. That stock straight away starts about 9% higher. Then you have some more names like NMDC Steel, IOL Chemicals. These are the early movers. Lemon Tree, early movers in the mid-cap market. Some PSU banks are coming up on the screen now. PSUs and PSU banks. So NBCC, Union Bank of India, SAIL, NMDC. These are some of the PSU names that are off to a positive start. But you have to say the mid-cap market is not roaring away just yet. I mean, the close yesterday was absolutely phenomenal. It's very early. We've just started, but there is a hint of positivity around it for sure. And the Nifty not bad at all. 20,151. Bajaj Auto, M&M, Tata Motors. It's an auto morning, must tell you that. Autos are getting really, really excited as we approach the festive season with Ganesh Chaturthi next week. And metals continue to trend higher. CRR cut in China, or reserve ratio cut in China yesterday. In general, metals are not bad at either this morning.
Okay, well, long list of stocks there. 50 points higher. We're at about 20,150 at this point in time, and things are looking pretty good overall. Market breadth is good. I mean, you got about 7:1 in terms of advances to decline ratio. Take a look at the mid-cap index. Mid-cap index is up 0.5%, and you've got the small-cap index, which is up about 0.75% as well. I think we've kind of gone through a fair bit of names, but Restaurant Brands Asia is the big one, 10% higher, and that kind of continues with the tradition of, large blocks and then stocks moving up. CDSL is up about 3.5%, and there is Bajaj, which Sonia was talking about, Nimesh was talking about, which is up 3.5% as well. REC is up 2, Nalco is up about 2%, Titagar is up about 2%, and Shakti Pumps is another one. Shakti Pumps is coming up with about an 8% pop, so that's a big one. Two companies we had yesterday, Star Health starting 3% higher, and the other one was Narayana Healthcare, which ended up about 6% yesterday. So both were on the program on Bazaar yesterday, and both once again are following through with some gains here as well. So more in a bit from now. NIIT, the big stock of the week. I mean, NIIT, same time yesterday we were saying that how it's up 80% this week, and then it kind of climbed down a little bit. It's down a little bit more. It's down about 2.5%, but still 75+% in 4.5 days with today to go. Mahesh Patil is now joining in to run us through what he's making of things and how he's seeing the markets coming through at. He's Chief Investment Officer at Aditya Birla Sun Life AMC. Mahesh, it's a pleasure.
Yeah, good morning.
Great to have you with us here, and thank you for coming in. How are things looking, Mahesh? Are you, a lot of fund managers we've spoken with, especially, your colleagues over at, not colleagues, but peers over at Kotak, they've been sounding the alarm bells and caution as far as the broader markets go, mid and small caps, etc.
Right.
Are you as concerned, or you think, it's a longer runway here?
Yeah, so I think there's no doubt that the market in the last, few months, we've seen a steep rally over there. And arguably, because of the liquidity which has been there, right, both domestic as well as foreign, we've seen stock prices go up. And more so because a lot of inflows in the last 6 months or 1 year has been, especially domestic flows, have been in the mid-cap and the small-cap segment. In the mutual funds. Almost like 40 to 50% of the incremental flows are in that category, and that has led to some kind of a, outperformance, right, in that space. But I think if I look at from a slightly medium-term view, I think India, overall the outlook on growth is looking fairly decent. Despite the global slowdown concerns which you might see in the next couple of quarters. And the good thing is that there are a lot of sectors which are participating in that. It's not like one or two sectors, it's more broad-based. If you look at right from the banking sector to the investment cycle now, which is picking up after a long time, the real estate sector, even pharma for that matter, and even the IT sector, right, which is likely to get the brunt of the slowdown, looks to have bottomed out over there, right? So given that, I would say that the market still has longer legs. When you see a sharp rally, okay, there is some pullback, okay, which could always be there. But even in the mid-cap and small-cap segment, it becomes more stock-specific then, right? The broader market or the index might look a bit expensive, especially in the small-cap space. But there the universe is very wide. You need to look at new ideas over there. And I think while the valuations look expensive on a trailing basis, but I think if India growth story plays out as we think, and if we have stability, that elections are there next year, but if the election results are good, I think you could have a long runway of growth for India. So in that scenario, the earnings growth in mid-cap and small-cap would be much stronger.
Sure.
So they're not expensive, you're saying? Despite the run-up, you're saying that
yeah, it's expensive. One can see you can't sell and again get in, right, into the market. That's always difficult, even for fund managers and even for investors. So, don't go aggressive, okay, stick to your allocation. I think that should be the mantra rather than trying to get out of the market.
Okay, since you're talking about mid and small caps,
yes.
My colleague Nimesh is waiting by. He has a company on his radar, Restaurant Brands Asia. So let me just go across to him and I'll come back to you for your thoughts on that. Nimesh, over to you. Why are you tracking this one?
Hi, Sonia. So there was a 25% block which got done in the block window today morning. I hinted as well that there's going to be a large block in Restaurant Brands Asia. What I understand from sources, the promoter entity, which is private equity Everstone, they sold 25% stake in today's block deal. Since the block happened in the block window, it do suggest that the demand was quite strong. But I understand 90% of the book was bid by the long-only funds, and only 10% was given to the hedge funds. Now, the Everstone, the private equity owns close to 41% stake in Restaurant Brands Asia, and they've sold it at 25%. So nearly 70-80% of the stake they've sold by a block deal. And again, this has been the trend. After a large block, the stock moves up. The fact that the demand was quite strong. And also for QSR, overall in general, looks like the quarter 3 and quarter 4 are going to be quite strong. So there is momentum now. But the fact is in Restaurant Brands Asia, what I understand from sources, the promoter entity, Everstone, has sold today 25% stake to institutional investors.
For that, so that's on Restaurant Brands Asia. But Mahesh, I wanted your thoughts on this, for the mid and small cap space. You're saying that there's still perhaps a longer runway, right? So How do you sift the wheat from the chaff? What are the pockets that you would look at? What are the sectors that you still like despite the rally?
Yeah, so I think, again, one can't take a shorter term view over here. I think you have to be slightly careful because few stocks, okay, because of liquidity, we've seen a sharp run up over there. But I would look at companies, okay, where the runway of growth is much longer. I think some of the cyclical names, okay, which have run up, I think there could be probably in this kind of run up when there's a downturn, you could see a larger kind of drawdowns over there. So structural stories, right, where say for example, again, whether it's in the consumer space, right, we've seen a lot of good mid cap and small cap companies coming into the market recently. And India, we believe that the consumption story, really, the discretionary consumption would have a long runway of growth. I think we are at an inflection point where your per capita GDP is now at around $2,300, and short term there's weakness because of rural slowdown, but I think that should also come back. And in fact, getting into election, you will see a lot of spending happening, right, by the government, and which could drive consumption. So we look at sectors where the runway of visibility is good. So even if there is a short-term correction, I think you would not really panic and want to sell out, right? You will use that opportunity to add in.
Sure.
So stocks are sectors where the conviction is higher, runway of growth is better. I think those are sectors which we would like to own. Though I would still caution that, yeah, I mean, one needs to be cautious over here, right? In that, I mean, not be aggressive and look at it, wait for the opportunity, don't chase price point, because we've seen, I mean, any slight positive news or liquidity and the stocks just run up. I saw today, right?
Yeah, and then they correct. I was just noticing that I think on railway stocks, the correction is hardly 15-20%.
Yeah, so
after a run up, which is 200%.
Right. So that you have to be careful in those pockets, right, where they run up. And valuation, I think valuations, I think fundamentals, I think needs to again look at it and see. I mean, market, you're not going to get stocks cheap, right?
Sure.
Because the liquidity in the outlook is good, but at the same time, reasonable, I think some consideration for the outlook growth. But I think that framework, if you keep in place, I think one should be fine.
So, Mahesh, let me ask you one thing. What is the risk to this market? And I'm not going to ask you about inflation, because inflation is a consensus. And when there is a consensus known risk, people say it no longer is a risk because the market knows that you're working with that. Aside of some complete tear in inflation, we're talking about crude at 94, monsoons are doing what they are.
Right.
Apart from that, is there anything else that we're missing?
So I think, see, if you look at the concerns really are from the global side, because that's where the sharp increase in interest rate happened, right? I mean, the increase in interest rates in the US is historical. I mean, we've not seen in many decades. And that could lead, while US growth is still fairly good, I mean, we have seen not any major shocks, but that kind of interest rate, and it could remain for longer. I mean, our view is that rates will remain higher for longer. And that could lead to some kind of a blowout. We don't know, right? I mean, these are unknown, as you rightly said, the known risks are already there. But the unknown risk is what you should be worried about. And that kind of environment, you might see some kind of a blowout which could happen. We saw some scare some time back, right, in the regional banks in the US, but that was more of a liquidity issue which was immediately averted because of a backstop by the central banks. But there could be some blowouts there. And the risk would essentially come from the global market, where you could see a risk off and you would probably have a collateral damage over here in our markets.
Mahesh, so which are the slightly longer runway, still good levels kind of areas? What specific pockets, if you can identify?
Yeah, so I think one is I talked about the consumer discretionary sector, which includes all retail, consumer durables. I mean, they are currently going through a slowdown, but that's a good time actually to look at it, because
Durables.
Consumer durables,
right.
then retail sector, right? All that space.
So durables, you mean white goods and stuff? I mean,
white goods and others.
Voltas and Whirlpool and
yeah. I mean, these are stocks which are currently still going through the competitive intensity and this thing. But again, if I take a 3 to 5 year view, that sector should see a reasonably good growth runway. Apart from that, I think even the power sector for that matter.
You said retail, and there you mean sort of what kind of names? Just to give an example.
So retail could be apparels, footwear, right? Even other retail companies, okay, which are there into, say, jewelry. So all that segment looks as good, more from a structural long-term perspective. Power is another sector which we are seeing after a long time sizable investments coming in, both in the thermal as well as on the renewable side. And that could another be a sector where...
But where, again, in power?
So power, utilities are still reasonable, I would say.
Okay.
The challenge in utility was that growth outlook was not that great earlier. But now the visibility of growth is looking much better. So they offer a reasonably good risk.
We just
reward.
had Sumit Kishore of Axis earlier, the analyst. He said valuations are kind of now they've run up. I mean,
Right,
so he said
right.
the sprint phase is over, his words, and now it's a longer, more calmer kind of phase.
I agree. So I think now in the market, you have to really look at stocks, okay, which will compound and give a steady return. Right? They're trying to chase big returns over here, and the market could be also risky. So you want companies where the runway, as I said, growth is fairly recent, and you play on that compounding, right? Anyways, on the broader market, we are not expecting any large returns, right? Our expectation return market is that it will be somewhere near its kind of a long-term average, 12, 13%. So any stocks which give you better than that with reasonable comfort, I think should be a good investment.
Do you like the equipment space as well? Power equipment?
So power equipment also should do well. Only challenge there is that a lot of stocks have run away quite a bit, right? So again, it's a question about then a balance between the valuations and the outlook, right? So you have to get both the things right.
We have a discussion coming up with HPL Electric. I mean, the smart metering opportunity in the power equipment space.
Right.
Do you own any of those sort of names in there?
Unfortunately, because it's a very niche and small segment. There are not too much opportunities over there. So we would normally look at some of the broader plays. Pharma also looks good over here, again, as a good defensive. And in fact, I will not be even negative on the IT sector, right? Because that's a sector which has been talked about a lot. A lot of negatives are already priced in. And the whole runway to digital, I mean, the move towards digital is going to be a longer term theme. It's not going to be like a 1 year. So we have seen currently a slowdown in discretionary spends in the US. But I think you've seen some of the companies getting some large ticket wins also on the cost takeouts. So again, good cash flow generating companies, reasonable dividend yields. So again, a good defensive, I think, in that sense.
I wanted, by the way, I just want to point out that Bajaj Auto is the stock that we should really be looking at. It's up almost 4% right now. It's a fresh high that Bajaj Auto is sitting at. And, you know, Nimesh was telling us about how Bofa Securities has gone ahead and upgraded Bajaj Auto and talks about how now Bajaj Auto has surpassed that 5,000 rupee mark, fresh record high there, and how most of their businesses now are firing on all cylinders and they're looking very good, even in, you know, the premium motorcycle space, the EV space. They're picking up quite a bit of pace there. I wanted your thoughts here, because this whole electric vehicle space has blown up, right, in the last couple of weeks and months. I mean, the sector is doing well, the ancillary stocks are doing well. Most of them are at all-time highs, whether it's M&M, Bajaj Auto, even the ancillary guys. Is it too late to enter here, or do you think there's more to go?
So auto sector has done fairly well in the last 1 year, right? Across, we've seen a good recovery there, especially in, say, commercial vehicle. It was four-wheelers, and now it's a two-wheeler space, right, which was kind of lagging behind. And we have seen decent, and again, the stocks, especially in two-wheelers, were fairly reasonable. They were not really that expensive. So I think, and again, the only challenge was the disruption, right? More so in the two-wheeler space, because that's where the adoption of EVs has been much faster. So I think, but now probably the landscape is getting more clearer, right? Which are the players which have got space also in the electric vehicle space, and market is trying to distinguish that in the marketplace. So again, on the auto sector, I think we think that the valuations there, right, are now pretty much factoring into that. Now it will be more of a steady compounding there, right, in terms of how the volume growth is going to be, where the market share shifts will be. I think that will drive the
some of these stocks like Bajaj Auto, for example, valuations are still not much higher than what their historic mean is. So do you think in that sense there could be more headroom?
So stocks like two-wheelers is the only sector, right, within the whole auto space is where it is still reasonable because of, as I said, the disruption fear, right, which was there on the electric vehicle side. And then others, some of the players have got a large amount of exports, right, which is there. So the outlook on exports there, right, is also important in terms of sometimes exports can actually balance out, right. In the domestic market, you might be losing, but exports could be doing better. But I think the companies which are able to really transform and able to have, say, even the electric EV space, to that extent, they are hedging, right, in terms of trying to protect their market share. And those are the companies, I think, which one would like to bet in the auto sector.
Mahesh, I think the million or billion dollar question that's on everyone's mind is that why have banks gone quiet? I mean, now the bank index is more or less moving in line with the Nifty, but we haven't seen that, you know, blue-blooded leadership that this market is used to every time it hits a new peak. That's not happened this time around. What's the chatter that you hear among, you know, large, investors, your peer set, when it comes to picking bank stocks? Why aren't we seeing that gold rush that is usually the norm with every rally?
Yeah. So I think banks, I would say is slightly over-owned sector, right? So it's been fairly overweight. Most of the domestic as well as we see, foreign will be slightly overweight. So that's one of the reasons, technical reason I would say. But apart from that, I think banks had a very good run last year in terms of earnings growth. Because last year they saw a large improvement in their net interest margins when interest rates came down, right? So now when interest rates have peaked out and your cost of funds are going up, So you would see this year will be a period of consolidation where your NIM will probably compress a bit.
So
right?
consolidation of earnings or consolidation for bank stocks? Because that has a market connotation.
So one is consolidation earnings, right? So which automatically means some amount of, but I think banks offer the very good risk reward at this point in time because the credit growth is still fairly good. I mean, we were expecting that this year credit growth will probably come down because nominal growth is much lower, but it's still fairly good. The credit cycle is still behaving well. I mean, the corporate side is really very benign. On retail side, there have been some murmurs that unsecured lending is seeing a very strong growth. So RBI has also cautioned a bit, but we don't see any real fears at this point in time. So I would say that rather than, and within the banking space, the shift is slightly more toward NBFCs because going forward, NBFCs will now see a margin expansion because as rates have peaked out and whenever rate cut happens, you will see that play out in the NBFC sector. So that has actually some money has moved to the NBFCs and they have done much better in the last 3 months.
All right, Mahesh, thank you so much for joining us here in the studio. Have a great weekend and thanks for speaking to CNBC-TV18.
Thank you.
Thank you.
Okay, well, for the market, it is holding up, but it's not really building onto its gain. So that seems to be the problem now. The Nifty holding at 20,100. The mid-caps are not doing badly at all. Little bit of tapering off of gains, but nothing alarming in the frontliners. Finolex Cables has been one of the strongest stocks in the last 1 to 2 years. This whole home improvement theme seems to be working for the company. As we know, real estate, has the entire sector has been booming as well. And the cable and wire industry continues to see healthy traction due to increasing housing and infrastructure activities. Deepak Chhabria, the managing director at Finolex Cable, joins us now. Mr. Chhabria, thanks a lot for joining us on the show. In Q1, there was almost a 30% volume growth that your company saw. How is demand shaping up at the moment? And, some of your competitors have done 50 and even 60% volume growth. Do you have similar scope?
The business is doing good. Volumes are increasing in this year. There is good demand in the market. We are basically a wire company, though we make cables, but wire is more than 80% of our business. And hence, we are driven more by the real estate sector. And that growth is coming well for us, and hence you see the volume growth of what you just mentioned.
Okay, what will be the volume growth for the year, FY24? Could it be 30% or maybe even higher?
Normally, we don't give forward-looking statements, but if you look at last year, we grew about 19% last year in turnover and about 24% in profits. In the first quarter, we've grown 19% again compared to last year first quarter, and a 38% increase in profits. So we believe the trend will continue, and I hope it gets better.
So you've taken 3 price revisions in the first quarter. Could we expect more in Q2? Have you done so already, and should we expect anything?
There have been some price decreases, and this is because the copper has dropped down, and which we stay with the market and change a price, copper being the main raw material input for our wires. And I think copper is steady now. It's been steady relatively for a long time. It's around $8,300 on the LME. And looking at the international demand, I think it'll remain steady going forward.
Okay, all right. What is the capex plan then, if you can tell me that, for the next, say, 18 to 20 months? What is the peak revenue potential based on your capex plan?
We have 500 crores marked as capex for the next 18 to 20 months. We are committed to projects in fiber optic, wherein we are growing the cable capacity from 8 million to 10 million fiber kilometer. Bulk of the capex, about 300 crores, goes in the fiber optic business.
Okay, Mr. Chhabria, just to talk about, the peak revenue potential as well, considering that you'll be undertaking some capex, what is that potential and what kind of asset turn do you see?
We believe in the next 18 to 24 months, we should be seeing a revenue growth of 2,000 crores. Some of it is because of this capex, and as I explained, when some of it will add more profitability in the company, like in the preform, when we go backward integrated, it won't increase turnover, but it will increase, it will stop us buying preforms and hence capture the value add in the company.
What kind of potential do you see in communication cables segment, both for FY24 and in the medium term?
we last year grew 50% in the communication sector. Fiber optic is a large chunk of it. But we are growing in, we make many products in communication, like we also make LAN cables. Now, LAN cables capacity, we've grown nearly 100% every year for the last 5 years. We've grown in CCTV cable. So there are other product lines in the communication sector which are also doing well. But fiber is the main focus.
So can that 50% growth be replicated in FY24, you think?
It can be. If the BharatNet project comes through, it can be. It's a matter of timing.
So you can replicate that growth in FY24. You're also scaling up your FMEG business. And, this is a space that's growing very fast. We were just talking to RR Kabul as well, the company that is in the same space as you. And they spoke about how FMEG is also a growing opportunity for them. Tell me, what is the revenue potential there and how much would you want to scale it up?
We intend in the next 2 to 3 years, we should do 500 crores in this segment. And there is a potential for each segment itself over the long run, let's say 5 years plus, to reach 500 crores individually in his own capacity. So our goal is long term. And that's how we are building up the range. We are expanding our distribution network to make sure the penetration is there for these kind of products. For example, we've changed from a single tier to a 2-tier network. The single tier network was our depots servicing channel partners or large shops directly. In a 2-tier network, we have a distributor and a retailer. So in this way, you can get to smaller shops, and the distributor services about 300 to 400 retail counters. And we can penetrate even into the B and C class cities quite effectively. So we've, in the last 2 years, added about 2 lakh retail counters to our network. And hence, this will take us in the journey for FMEG growth going forward. The other thing we've done is we have roped in Karthik and Kiara as our brand ambassadors, and we are doing a lot of TV advertisements to create a product pull. And I think this will also help us reach our destination for a 500 crore turnover for each product segment in the long run.
Yes, lots of marketing activities. We do see those ads. Finally, Mr. Chabria, you're almost at this very important milestone of 5,000 crores revenues. What about the next one? When do you see yourself reaching 10K? Is there a roadmap that is in place?
We are looking at standard wire and cable growth going forward because wire and housing is where the main consumption is. Housing has a great potential for the masses going forward. So we every year keep adding capacity in our plants, balancing capacity, and keep growing that business, which will continue growing going forward. In the power cable segment, we are also trying to grow. We have tied up with Sumitomo, and we are providing an end-to-end solution, which is going from 1 kV all the way up to 500 kV. We are probably the only company in India which can make 500 kV cables, and we are the only ones who supplied 400 kV in the market. So we are, but being a quality product, we are looking at luxurious buildings and places to supply. Now, in the FMEG segment, we will keep growing, and as I explained, we intend to target 500 crores in each segment going down the line. So let's say if you put all together, in the next 5 years, we should be crossing 10 to 11,000 crores for the company.
Okay, that's a very ambitious target, 10 to 11,000 crores of revenues in the next 5 years. Got that. All the best with your plans, and you've been a big wealth creator for investors as well. Hope you continue to do that. That is Finolex Cable. Just pull up a 1 to 2 year chart and you'll see the kind of momentum we've seen in some of these stocks that benefit from this whole home improvement theme or the real estate boom. Look at that, 130% in the last 12 months. Let's slip into a quick break. On the other side, Sanjay Kumar Jha, the Chairman and Managing Director at Mishra Dhatu Nigam, will be joining in, another big buzzer lately. After that, we'll also be joined by Gautam Seth, the Joint Managing Director at HPL Electric and Power, and Harshvardhan Dole, the Vice President Institutional Equities at IIFL, to discuss opportunities in smart metering. Stay tuned.
Welcome back. The market's holding well, and the one stock that's literally running away on the large cap screens is Bajaj Auto. Take a look, 4.5%. What a move. Actually, Hero is keeping it good company. I mean, these two-wheeler stocks, Eicher as well, they are just roaring away. Two-wheelers, it seems off on a long ride for the weekend. That's Bajaj, Eicher, TVS, Hero Motors and Eicher, all of them doing very, very well this morning. What's also been doing well is the mid-cap space, and the next company on our radar is actually from that universe. I just want to pull up the one-year chart first before we tell you more about it. Mishra Dhatu Nigam is the next stock and the next company on our radar, and it's been a phenomenal year for Mishra Dhatu. After many years of not getting any acknowledgement from the stock markets, this has been the journey in just the last 4-5 months since April. I mean, 100% up already. So what's powering it and what's the latest buzz? Of course, we know that Midhani, as this company is also called, successfully launched Aditya L1, first solar mission, and Mishra Dhatu has contributed to this crucial project. Not just this, even Chandrayaan, our historic touchdown on the moon, it was a lot of the alloys, cobalt, nickel, and specialty steels made by this company that were all contributing to these critical missions. Well, we have the managing director at Mishra Dhatu Nigam now joining in to talk about this. Sir, great to have you on the show. And really congratulations on all the fantastic work that you have been doing and all these historic missions that you're a part of. We just want to start by understanding the implication for revenue. So if you could tell us right now, whether it is Gaganyaan, Chandrayaan or Aditya L1, what is the contribution from a lot of these space programs from all the work that you're doing for ISRO? How much is that contributing to your top line? And, what's the margin in that sort of a business?
Yeah, and first of all, for all entire ISRO program, Mishra Dhatu Nigam Limited is contributing right from the starting of the ISRO mission. And we have been developing a lot of new grades, new type of alloys for these requirements. And you can see in the Chandrayaan 3, of course, it was right from the Chandrayaan 1, 2 and 3. So all the launches which we are seeing in the country going for PSLV and GSLV, our contributions as a material supplier has been very critical right from the beginning. And that's why we say today our entire space program is Atmanirbhar because of Midhani's contribution in their critical components, assembly and sub-assemblies. Now coming to the whatever we are contributing for this ISRO, if you see our last 3 years, our contribution and in our top line, basically will be almost covering around, it is fluctuating between 40 to 50% of our revenue coming from the space. And gradually, since already we have completed the entire supply right now, probably this year it will be coming to almost around 30%. And we are also waiting for their new projects to get sanctioned. And then again, we'll be participating in that this revenue journey of the ISRO. And
Mr. Jha?
Right now we are also having, yeah.
Sure. I just wanted a number to that, please, if you can help us. Currently, I think your order book as of July was about 1,400 crores. What kind of additional incremental order visibility do you have, and when would you hope to execute these orders?
Now, this year, so far, we have booked around 600 crores order already booking we have done. And we are expecting another 600 in this year, plus 600 plus in this year. And we are also targeting our revenue for this year in the range of 1,200 crores. So this will be our the total picture for this year. And in this journey, in fact, in our revenue, the defense will be having the major contribution because our order book for the defense sector has gone up. So this is going to contribute in the major way. But for the space, we are now looking for many new developments which we have done recently for the new alloys and new products, which I am expecting it will be coming in the future.
No, Mr. Jha, sorry, got that. When you're saying 600 bookings is what you've done into FY24 already, my question was more about execution. We know how much you've booked so far, but in terms of execution, how much will you be executing in FY24 and 25? And this 1,200 crores of revenues is in line with the 20% growth that you spoke about, right, for the full year?
Yeah. What I was telling that this year we are targeting a revenue of in the range of 1,200 crores. Will be companies targeting that. That is our
with 40%, Mr. Jha, 1,200 crores full year top line expectation. And you said 40% is coming from space/ISRO. 60% would be defense. Is that right?
Yeah, but in fact, it will not be 40 exactly. It will be coming less than that. 40 was previous year. This year it will be around 30 because since our volume has extent of revenue has gone up. So percentage wise it will be less, but the value wise it may be similar to that whatever we have done last year.
So, Mr. Jha, hi, good morning. Prashant here. For the last in FY23, 22, 21, revenues have been between 800 and 900 crores, right? So, is FY24 in that sense the breakout year? So, from about 870 crores, you moved to 1,200 crores this year. And will we continue to see this kind of growth in the coming years? Or this is kind of 1 year because of the order intake, execution, etc. Is this a one-off, is what I'm trying to understand?
No, we see what our growth of our revenue depends on that. What is our capacity for getting the production? So if you have monitored our company's capex infusion of last 5 years, we have almost commissioned our equipment costing around 700 crores of capex already we have commissioned. I think those areas I am expecting the more revenue. It is not because of the existing one only. So whatever we have done, the additional capacity, and also we did some diversification of our portfolio in terms of armor products. I think we are expecting the revenue coming from those areas, and I am sure that if you see our when we are coming for the next financial year for our results, definitely we will see that major contribution will come from our new facilities which we have commissioned recently.
So what is the the maximum revenue that you can make from your expanded capacity?
This is coming as a product mix. If you see last year it was around 900 crores, but this I am expecting additional 300 crores coming from the additional facility which we have added. But the potential is also it is having more. We are trying to add further some of the augmentation of the facilities, and it will be increasing. It will be giving the increased output in the future. So we are targeting. We are in line with the Defense of Ministry this target for going to that almost 20 to 30% growth every year. This is the target by Ministry of Defense, and Midhani is also targeting.
Mr. Jha, got that. That gives us clarity on your top line ambition and your top line expectations. Let's just quickly talk about margins as well, because you've been around this 30% handle, I think, for the last couple of years. As you're doing all of this, highly specialized work, do you have any scope to increase margins at all?
If you see our margin today, 35%, 30% is quite high. And since we are entering in the more and more volume, and many of the orders which we are going to get is from competitive bidding. So once you are entering in that domain, definitely we have to see that margin will be, there will be pressure on the margin. Nevertheless, we are having the mixed of the products. Some product we have the more margin, some we have the less, so we have to balance. And the company will be trying to reach in the same range what we have done in the previous year also, and of course in the last 4 or 5 years. So our target is that.
In the same range as the previous year. Got it. Sir, sorry, we're actually running out of time. I just want to focus on one last question. Earlier, I think when we spoke to you, you said that there could be an OFS likely this year itself, in this calendar year. Can you give me an update on that? Anything on the horizon?
OFS is not directly handled by us. It will be done by the ministry. and there's a plan is there, but I don't know what time they are going to announce this. But it is in the offing from last couple of years, but it has not
But
been
anything
materialized so far.
anything in this calendar year, you think? I mean, as per the discussions that you folks have had?
We have no idea on this issue, and probably it is under consideration by the ministry. Deepam is looking into those aspects.
All right. Great speaking with you, sir, and hope we have the opportunity to kind of connect regularly with you. Appreciate you joining in, and congratulations on the very strong performance that you're expecting this year. Stocks, of course, done very well, but from one winner to another winner, different space, but this is the power space we are talking about. Now, the government targets to roll out 25 crore smart meters by FY25. The revamped distribution sector scheme has a total outlay of 3 lakh crore rupees over 5 years. The opportunity is very large. The runway is large. Stocks have done very well as well. We have Mr. Gautam Seth, Joint Managing Director at HPL Electric, joining in. We also have Harshvardhan Dole, Vice President, Institutional Equities at IIFL, joining in. Harshvardhan, of course, wrote a report on this a couple of months ago in terms of the large opportunity that the sector provides. Mr. Seth, great to have you with us here. Good morning. Thanks very much. Prashant this side.
Yeah, good morning.
So, the opportunity, I think, is now well understood, but a fair bit kind of depends on execution. Just a couple of numbers if you can give us. What is HPL's sort of installed base of smart meters now? What is the capacity at HPL Electric? And how will these numbers sort of progress as we go forward in FY24 over FY23, FY25 over FY24? Will we see a big step up in these numbers?
Yeah. Good morning, Prashant. If you see our capacity, we are well over 1 crore meters per annum. And in terms of the installed base, if you look at the installed base from over the years, it is probably runs into a couple of crores. I probably don't have the number immediately. But if you see HPL Electric's execution and the order book over the last even the 4 to 5 quarters, that has been going up. And as we speak today, we are currently sitting on almost 2,200 plus crores of orders. The execution is also increasing on a quarter-to-quarter basis, and so that is how we have been seeing the movement of the execution and the orders. Going forward, definitely we are going to see a huge increase in terms of revenue and our installation base, because most of these orders which have come in have been in the past 3 to 6 months, and in the orders under the RDSS, the AMISP orders are, they do require almost 6 to 9 months before the installation starts. So a lot of these orders which were received are today either under production or they are starting to get installed. So we definitely would see a much larger volume in terms of executions as we go forward.
Okay. Harshvardhan Dole is also joining us to discuss more about, the role that smart metering is playing in the entire ecosystem, as well as how the orders are surging. Harsh, thanks a lot for joining in. If you can just start, for the benefit of our viewers, explain what is the opportunity in the smart metering sector over the next couple of years. How do the economics work at the moment? And how does this help, the current players in the ecosystem?
Hi, good morning. I think the opportunity is quite significant. If all the state discoms were to switch to smart meters, I think the opportunity could be well in excess of 25 crore that has been talked about. And it basically could come in 2 forms. One is the discoms doing the capex on their own, which seems quite unlikely given their weak financial health, and therefore they call in for competitive bids and procuring meters, and they paying basically on a monthly basis. In my opinion, this is a model which is largely being explored by the private sector, and if it works out, it will be a great win-win for the private sector as well as the discoms as well as the consumer. I think it will be a stepping stone to turn around the whole sector, because then the whole data management will be in place, and somebody who's quite mischievous in not paying essentially bills quite be monitored, and hopefully the DISCOMs can take corrective action to plug off the power supply. So this is a good stepping stone, but I wouldn't say the ultimate one, because the smart meters ought to be, supplemented with prepaid features, so that the working capital issue encountered by the state electricity board can be addressed once and for all. So I hope states take cognizance of that.
Okay. Mr. Seth, come in on your experience so far. You've also, gotten into a tie-up with a company known as Wirepass. Pardon my pronunciation, right? So I just want to understand from the HPL Electric standpoint, what's your game plan for smart meters? I mean, will you bid for contracts directly, or will you in turn become a vendor for those like Tata Power who might be bidding? And in this entire value chain, I mean, what's the value creation for you in terms of profitability, in terms of just, what's the revenue potential from the smart metering business?
Yeah. So if you look at it, in the past, in the immediate past, our focus has been to, be one of the leading supplier of smart meter to all the AMI SPs, and that is what our main forte has been. Our preparedness for, in terms of R&D and in terms of all having our complete preparedness on the resources in terms of infrastructure has already been completed. Now, looking at the way, so that is the primary objective and the opportunity what we see. Apart from that, the smart meter opportunity is also throwing up a lot of new opportunities which come into in the whole in the ecosystem, and the communication network is again one of the very strong part of the complete AMI SP rollout. And
so, Mr. Seth, can you put a number?
Yeah,
we're a little short on time, so I mean,
okay,
some numbers would help. So,
So our tie-up with Wirepass has been that we have today a very strong technology of the RF mesh coming in. They are providing the software stack. Our with our resources and the integration, we can be providing the communication technologies as well along with the smart meter. So that makes us again looking at the ecosystem in a bigger way. In terms of numbers, definitely, we are sitting on almost over 2,000 crore orders, as I said. Going forward, on an immediate basis also, we do look at almost a similar kind of orders to come out, because the opportunity, as Harshvardhan said, is huge, and we definitely will look at a...
No, and what revenue does it translate into? 2,000 meters, yes, but I mean, we are not aware of pricing dynamics, etc. Ballpark, what's the revenue you can make from smart meters this year and in FY25?
So this year, I think combined, if you look at, I think anywhere it can be over 1,500 crores or even 2,000 plus crores going forward in the immediate 1.5 to 2 years.
Yeah. So sorry, 2,000 crores overall company revenues in FY25.
No, so we, I would say in this year we are looking at anywhere between 1,500 to 1,600 crores for this current year. But the next year, beyond that, we will see more of the schedules for the smart meters kicking in. And that is where we see again an upside. So it could be 1,800 or it could be 2,000. But definitely, in terms of all our businesses, we would see an upside going forward.
And margins will stay around this 12% zone?
No, the meter margins, the EBIT margins are around, you can say maybe 13 to 14%. But on an at least on a short-term basis, we would see the meter margins start going up as the smart meters become a much higher, proportion in the total order execution.
So, I just had one question. You said earlier that you have a capacity currently, I think, of 1 crore meters, right, per annum. And you have, of course, this opportunity, 2,000 crore order book, etc. Can you tell me if there is more capex that you plan to put on board to up your capacity? And if yes, what is the kind of investment that you will make in capex over the next 2 to 3 years? Would that mean any pressure on your balance sheet?
No, in fact, if you see, since the last 3 to 4 years, our capex and preparedness has been there. And we have, in fact, been waiting for this kind of an opportunity, which has come now in the last 8 to 9 months. But despite that, when we see the rollout and as more and more meters are getting executed, we have been investing we have been expanding our capacity because this is a flexible capacity in a way that Recently, we've just upgraded our electronics section in a bigger way to enhance, to bring in faster productivity and much more better automation. So a lot of work in our factories is going on the automation to bring out much faster, better products at with the minimum resources. So a small, I would say, more of a maintenance capex has been going on, but the large capex and our preparedness, as I said earlier, has already been done to exploit the opportunity which would roll out in the next 3 to 5 years.
Harshvardhan, very briefly, we're in an election cycle, right? And power is a hot subject there. Is there any risk of derailment? Not just this, but I mean, because we've been seeing a thrust towards reforms in the power sector, or is that not a risk? This is what we've started on. We'll continue to stay on this path. Harshvardhan?
I think this time the structure of reforms is quite different. This time states have to perform in order to get incremental grant. And essentially fungibility of funds does not exist. And to that extent, the seriousness is very different than what we have seen in the earlier cycles. So I would expect the momentum to continue. It's just that, the state level politics is quite different than what center envisages. And that is what the cause of concern is. I mean, I'm sure you would have read in several newspapers that one of the southern states, the center says is basically on the brink of bankruptcy. If that is the case, then, such reforms will get paused. And I hope center and state will work together so that these reforms can be taken to logical conclusion. Otherwise, as such, it is quite a sensitive issue when it comes to election year.
All right, gentlemen, we'll leave it at that. Thanks a lot for joining us and talking about the smart metering opportunity for the entire sector, as well as, for your business, Mr. Seth. All the best. Let's take a quick break. On the other side of the break, Brent crude prices continue to be at, 10, 11-month highs. Brent is now at $94 a barrel. More on the commodity markets with Manisha Gupta in just a bit. Welcome back. The big global headline has been the surge in Brent crude prices on account of supply pressures that we're seeing globally. Manisha Gupta is joining in now to talk about that and more. Manisha, what's the one commodity that you're tracking today?
Oh, absolutely, crude oil prices, because, until now we were tracking the Brent, which has been holding above $90 a barrel, but you have the WTI crude price is also trading above 90, and Brent is at 94.5. It has been a gradual but one-way direction for the crude oil prices, which has been on the higher side. So we are trading at a fresh 10-month highs for the crude oil prices. This is going to be the third straight week that you are looking at gains coming in for the prices. And when you look at the kind of gains that we put in for this week is about 3%. On a monthly basis, we have seen strong gains come in for the crude oil prices to the tune of 15%. And since the month of June, we are up 15% as well. For the year, for now, we are now up nearly by 13%. So positive cues coming in every chart that you see, near term or a longer term for that matter. If you look at the prices in this year until now, we started the year slightly on the weaker side at around $82. The reason that you have seen strong run up in crude prices also is because in the last 2 or 3 weeks, every data that you pick up, there is a strong hedge fund buying coming in for the crude oil prices. Also, additional to that, the China cutting its RRR by 25 basis points for a second straight time in this year is also supportive. China clearly has been importing a lot of crude, even as the economic data number has been on the weaker side, but the Chinese import numbers have been positive, and with this now push coming in, you are looking at even higher prices expectation. As I was saying, if you look at this year, we started this year with 82, saw a decline up to 70 in the month of June, and we're trading at $94 right now. So from June, the run-up for the crude oil prices have been quite strong. This also is a period that we have seen OPEC and allies, especially Saudi Arabia and Russia, continue to talk about output cuts, and they have actually managed to bring the crude prices to 90. The major run-up in crude actually has come in these 3 weeks, where we saw the prices gain up from 82 to 94. This is the fourth quarter estimate, and this is the number that the crude prices really seem to be surging on right now. The output cuts, the supply concerns, the strong demand expectations mean that by the fourth quarter of this year, we could be looking at a deficit. Now, this is the deficit estimates that various agencies have put out, and most bullish clearly coming in from OPEC there. We also are looking at strength continuing because the demand estimates have been on the stronger side as well. So for 2023, the demand estimates feature between 1.8 to 2.4 million barrels per day. But whichever way that you look, it's more than 100 million barrels per day of a day consumption that the global market seems to be looking at, and that clearly has been supportive. Let's take you to the forecast then, and 94, 95, 100, 105 is what we've heard from Saxo, Probis, Goldman Sachs. They're all bullish on crude oil prices, and they have been. I mean, these are forecast as long back as the month of June, and have continued to hold on these levels. 90 to 95, 90, Bank of America, fat profits. Wood Mackenzie believes $88 a barrel, but Wood Mackenzie on CNBC-TV18 also told us that they could be looking to change this, revise it on the upside there. The least of bullish actually have been coming in from Indian brokerages, though. We have seen them come out with levels of 88 to 98 on the higher side. Having said that, the markets do believe that we are overbought as far as crude prices go, but the momentum still continues on the higher side.
Okay, well, Manisha, thank you very much for that. The PSU banks are the ones which are once again roaring. So you look at names like Central Bank, UCO Bank, Indian Overseas Bank, huge volumes and straight 4 to 5% gains on all these public sector bank names. The index, the PSU Bank index itself has cooled off a little bit, but it's still up 0.5%. So that's just something I wanted to point out. But it's a very buzzing market, 3:1 advances to declines. Broader markets once again outperforming what the Nifty is doing. We'll take a quick commercial break here. On the other side, our special segment, Indianomics. Lada will connect with Mridul Sagar, former executive director at RBI. Sajid Chinoy, chief economist India at JP Morgan, also will join in, and they'll discuss the 15 years post the Lehman crisis and the 10 years after the taper tantrum, where we're at. Stay tuned.
Today, September 15, marks the 15th anniversary of the collapse of Lehman Brothers, which led to over 3 months of chaos in global financial markets and practically seizure of all lending by banks everywhere. September 2023 is also the 10th anniversary of the taper tantrum, a slightly smaller problem perhaps, the Fed pulling out dollars that it had printed to solve the Lehman problem. The taper tantrum hit India harder than many other countries, taking the Indian rupee from 53.50 per dollar in end May to 68.80 per dollar in end August 2013. To understand what lessons we have learned from these two events and how they have changed both financial markets and regulatory approach to financial markets, I have with me two experts who saw this crisis literally inside out. Mridul Sagar, the former ED and member of the RBI MPC, who was in RBI at that time, now professor at IIM Kozhikode, and Sajid Chinoy, chief economist, JP Morgan India, who I guess tabulated everything that happened from the outside. Gentlemen, thank you very much indeed for joining me. Mridul, let's first take the big lesson, work backwards as it were. Is it fair to say that ugly as the Lehman crisis was, the lesson learned 15 years from now is banks everywhere are a lot better capitalized, lot better safer? Mridul, I think you're on mute.
Okay. So I had unmuted myself.
Yeah, okay.
So,
yeah, we can hear you.
Okay. Actually, the 15 years of global financial regulatory reforms have definitely strengthened the resilience of the financial system. But it's still a bit of unfinished agenda. I don't think we need to slacken on that. Clearly, the capital buffers, the liquidity buffers, the LCRs, the NFSRs, in terms of the TLAC in particular, ending the too big to fail, they are very important measures which have been taken. But I am a wee bit worried that the political consensus on these reforms is still lacking, and it is contingent on what might happen in the US in the next presidential elections. If we have survived the banking crisis, which was emerging earlier this year, it's essentially on the back of the global financial regulatory reforms. Okay.
We'll come and develop that point a bit. But Sajid, to come to you, since you wrote about the great unraveling, Sajid, do you think that it is, while the banks and financial institutions have been strengthened with capital buffers, would you say that it has led to a lot of inequality because the Fed just flooded the world with low rates and a lot of liquidity, and we are still paying the price for that? Okay, Mridul, I think, Sajid, we can't hear you right now. We will come back to you in a minute. Mridul, would you agree to that the manner in which it was solved by liquidity is a price that we are still paying?
Absolutely. Again, Lata, I think the unconventional monetary policies have gone too far, and we need to sort of see its unwinding. So these are not very standard tools as the West countries have begun to think. And these should be used sparingly in times of crisis and should be rolled back. In all fairness, Fed is the only central bank which rolled back the unconventional monetary policy after 2008 crisis. The ECB, the Bank of Japan have not been able to do that. So I have some sympathy for Fed on that. But again, I think it's a word where too much dependence is there on forward guidance, as if markets have, it's not the job of the markets to take positions on what might happen. So everything, all risks, the markets don't want to take now. And that's something we need to correct.
Okay. Mollycoddling of markets by regulators is what you're pointing out, being too beholden to markets. I think we have Sajid back on the line. Sajid, while the positive of the Lehman crisis appears to be that banks everywhere are better capitalized, would you say the manner in which it was solved by gushing out liquidity has created problems even up until today?
Lata, I agree. I think the implications of Lehman are far more profound and far more long-lasting and are impacting us even today. Let me give you three implications. I think one is that the recovery post-Lehman was very anemic, right? It took 8 years for the global economy to close its output gap and go back closer to trend level. And that economic malaise or stagnation actually, in my mind, helped sow the seeds for, deglobalization, secular stagnation, was blamed on globalization in some quarters. And, this was the decade of Brexit and the US-China trade war. And I think those deglobalization tendencies got firmed up in that decade of malaise. The second lesson in my mind was the misuse of fiscal and monetary policy that you alluded to. Fiscal policy was inexplicably too tight. Structural fiscal deficits in advanced economies tightened between 5 to 10 percentage points of GDP in a decade. And that choked off the economic recovery and contributed to the economic malaise. Now, the implication of that was by the time policymakers realized in 2018-19 that fiscal had tightened too prematurely, the pendulum swung the other way. And the next time a crisis hit, which was the pandemic, fiscal policy overcorrected in the pandemic, and we're still paying the price of that from some advanced economies. The third implication, as you said, was, because fiscal was tightening and there was this economic malaise, monetary had to do all the heavy lifting. And once the zero lower bound was hit, this whole Pandora's box of unconventional monetary policy opened up. I would argue it had a really crucial role to play in 2008-9 to avoid the recession from getting worse or facing a depression. But what happened was, once this became mainstream, as Midul alluded to, then monetary policy soon became the only game in town and began to substitute for more important structural reforms. So I think all of these three factors, the wrong choice of fiscal and monetary is still impacting us. It dictated the way policy acted in the pandemic. And I think part of the high inflation we're seeing around the world is because fiscal policy moved too aggressively, having learned the lesson that it was too tight after Lehman.
Okay, so I don't know if when history is written for this period, the fiscal policy will be blamed, just as we now blame monetary policy for the 2008. Coming to you, Mridul, go ahead.
A slightly different take from Sajid on this one. And while I completely agree with Sajid on monetary policy becoming the only game in town, I have to say that the counter-cyclical fiscal policies are the need of the hour. And that's not something we are doing, but that's something which actually helped the West actually give a larger fiscal stimulus at the time pandemic shock came. So you look at how Eurozone really rolled back the fiscal side, because if they hadn't rolled back the fiscal side, the fiscal gaps would have remained too large to give the fiscal impetus.
Okay.
So that's the limited
Fair
point.
enough. I mean, we'll analyze it more, but let me come to the taper tantrum. I mean, as Sajid points out in his paper, in his latest paper, the taper tantrum completely exposed India in terms of a country at that time with a high current account deficit and its inability to immediately react to the coming crisis of taper. But now, although the tightening of the Fed was much higher, from May 2013 to August 2013, the Fed hadn't tightened so much. It had only said it will tighten. But this last 12 months, the Fed tightened all the way from zero-bound interest rates to 5.5%. But the rupee was as sturdy as ever. So do you think we learned the right lessons from the taper tantrum, Mridul?
Okay, see, the two events were very different. The taper tantrum and the current tightening was very, very different. So in taper tantrum, fragilities were very large. India was part of the fragile five. Clearly, the fiscal deficit was ballooning to 6% of the GDP. Growth was falling sharply from above 8 to more like 5% in that year. Inflation had shot up to 11%, plus current account deficit had ballooned also to 4+. So the moral of the story is that one has to stay focused on macroeconomic stability, because without that, nothing can get done. The lessons of the taper tantrum were learned, and in the sense, the Fed has been more restrained in communicating the tapers, which it does, prepares the market now. In taper tantrum, I distinctly remember that Esther George was dissenting in each FOMC, and Powell was also taking the same line, but not dissenting.
Mridul, we'll come to that in just a bit, analyzing it nuance by nuance, but we have to wrap up for Bazaar viewers. The key lessons from our experts is that the Lehman crisis, grave as it was, it taught us that we have to shore up banking sector, in fact, lending companies with a lot of capital. That's a lesson learned. And from taper tantrum, India learned the very big lesson to keep fiscal deficit and current account deficit, basically your macros, under control. Valuable lessons that we will remind our viewers on the 15th anniversary of Lehman and the 10th anniversary of the taper tantrum. Going to a break, we continue with the conversation, but viewers can watch the entire chat later on in the day.